Hello, welcome everyone. We are Team 6, also otherwise known as Goldmen-ish, Goldwomen-ish, actually we changed our name. And today what we'd like you to do, what we would like to do is we would actually like to walk you through our simulation. So we're first going to start with how do we make our decisions. Here is again a reminder of how in general, how you go through the process. After that we will go into each of these stages individually, give you a little bit of an insight what we made our decision, how we made our decisions. Then we will talk about the key results that we got out of the simulation and the lessons that we can learn. So the top 5 challenges throughout this process that we identified is that first of all we need to estimate what the future market will actually look like, right? Because we only have information for right now. The second challenge is that we have to also think about what are you guys going to do, how are you going to react? So we have to evaluate our competitors. We also had to, as the professor just mentioned, we had to balance short-term versus long-term gains. So for example, we had to look at, do we want to just progress in this specific round, or are we really looking into the future in the next few weeks, or in our case, years? Then also we had to, obviously, when we went through the process, for example, we were at production, but then because of a decision we made in that specific stage, we had to go back, for example, to demand and readjust that. So there was a lot of reiteration. That was one of the challenges. And obviously we were in teams, so we also had different approaches how to make decisions. So that was also something we had to take into consideration.
So for the market outlook, you all read this part. We considered the 3 main topics that were of importance in the market. First of all, the growth rate for the US, Asia, and Europe, that were the different growth rates. Second of all, we also looked at the expectations for the market for new technologies. We read that Asia and Europe were going to have the highest expectations for the Tech 2 in this coming year, so we took that into account very importantly. And lastly, the taxes and tariffs that are being taken into account from transferring products from one place to another. For example, the US has a lot of tariffs to pay when it comes to China, and Europe is a very expensive place to be in the market. For demand, we really wanted to estimate the best way that we can maximize our production, and we did this by iterating and doing a scenario analysis of how would our income statement, how would our profits look, how would our balance sheet look if we produce more of Tech 1, more of Tech 2, how do we outsource, where do we outsource? So that was very, very important. We had to calculate the market share growth, how much do we plan on growing, and also, of course, including Tech 2, like Cindy was previously saying, when we did R&D of Tech 2, we realized that we had to go back to demand and establish a whole new line of business for our competitors. So we based ourselves in this graph for all the countries. How much are we going to grow? How much does this demand, and how are we going to play this game? Lastly, production. Based, of course, in the demand that we forecasted for Tech 1 and Tech 2, we combined and exceeded the production capacity of the company. We outsourced as much as we could, and we still had a negative or a loss of demand that we could not supply. So Tech 2 was outsourced to the US because of production costs, and Asia was doing Tech 1 because also the demand for Asia was very big, and we were expecting a growth of over 25% in Asia. And currently there are 12 plants in the US, and we grew our production this year by 50%. So if we are going to continue this growth rate, or even half that, we are going to need to produce more units, and this means investing in more plants. So looking at production planning, unsatisfied demand is our basis towards the rest of the simulation.
So moving to research and development, we decided to divide both, to use both in-house sourcing, in-house development, as well as outsourcing. This due to the fact that by being able to license and therefore buy the technology would have been available immediately. And this would have allowed technology to be developed further, making the features available immediately. Moving to marketing, these are the main key findings. And first of all, there were several features for all technologies. The selling price it is possible to see increased compared to the previous round for all the 3 countries. And in case of USA, just by 7.14%, but in both Europe and Asia, 10%. Important is also the promotion expenses. In this case, in fact, the promotion expenses was increased for technology 2, which was a new technology, and instead we decreased the promotion expenses for Technology One, and we found out that there would be an increase in demand both for Technology One and Technology Two.
For logistics, for Tech 1, we considered that both demand and profit should be considered for different continents, and according to that, the US had the lowest production cost, and that's why we selected US as the highest priority for Tech 1. And for priority 2, that was Asia, it has the lowest tax rate of only 15%, and the priority 3 was Europe. For Tech 2, it was solely based on profit margins. So since Asia was, Tech 2 was outsourced to Asia and the cost was lower in Asia, so we preferred Asia as the first priority with the highest gross profit margin. Europe was the second one of them, and third was US because the Tech 2 was still underperforming in US. So for transfer pricing, since the tax rate for Asia was only 15%, while in US was 35%, so instead of increasing the profits for US and reducing it for Asia, we kept no transfer pricing for Asia. And for Europe, we kept a transfer pricing of 1.9. So according to this, US had to pay no taxes and Europe had to pay minimum taxes of only $1.6 million. The effective tax rate for the company was only 20.17% with the highest profits of around 393 million.
Yeah, coming to the finance topic. So our situation was that we don't have short-term debt right now. That's the possibilities we can adjust as internal loans in Asia and Europe. The increase of long-term or decrease of long-term debt, and we have the opportunity to issue shares, buy back, or paying dividends. And the challenges we were asking in our group was like, okay, what is paying the right amount of dividends and finding the balance between the long-term debt and equity. So we increased our shareholder value in this round by 6.6% and had a great shareholder return so far, which is still the main goal of this simulation. And our key questions for that: what are our expected costs? Where we want to go to invest next, like in R&D, in which features, and also in how many plants we want to build in Asia, and how to balance this. So right now our equity and long-term debt in the last round was 64 to 36%, and we increased our equity from 75 to 25% based on the decisions we made. So we issued 3,000 shares last round and increased our long-term debt by 300,000 to make future investments in R&D and plants. And our outcome this time was we increased our ROE by 2% from 28 to 30%, and showing financial health to potential investors in this round, and got a credit upgrade, so even the cost for long-term debt is now cheaper. And that is for us the outlook that we can. We have to overthink our debt to equity ratio now, and look how our capital and the weighted average is on the best allocated, and increasing our P/E ratio. So our sensitivity analysis was based on the WACC and the long-term growth rate, and shows how our market cap would be developed as the WACC and long-term growth rate is changing. It was one of the tools we used out of the class 1 to do the simulation.
For scenario analysis, we base ourselves heavily. This is just one of the examples of how can production and demand affect our scenarios. So for low production and low market growth or even market decline, we got a loss of over 120,000. And since we are already at the peak of production pretty much, increasing demand will not give us that much more profits, given price sensitivity of customers. So scenario planning was one of the biggest scenarios. We discussed it, we evaluated, we iterated in different scenarios to base our decisions in the best results possible.
So we had projected a cash flow initially while we were performing the simulation, and we had got an EBITDA of only 156 million, which was pretty less than what we actually achieved. And the actual profit was EBITDA was 522 million, and the cash at the end increased by around 300 million for us.
Yes, so to summarize, obviously we want to know how did we do right in comparison to each other. So one thing that we saw is that if we compare, these are all the other companies, this is us, and we can see that we are actually the company with the highest market cap based on our decisions. Secondly, we can also see that we are the most profitable company. This is us again, divided by the different markets. And also our shareholder return, which is obviously what we were in the end looking for, was the highest with an increase of 36%. So now when we reflect on what happened, we can see that. Thank you. So what seemed to have worked very well for us is that we tried to stay realistic. So we really looked at it as a real company. We balanced the short and long-term factors, and we also looked at the bigger picture of the company by going back and forth. And we also have a lot of points that we would like to improve for the next round, which is that we want to look at Asia because there was less growth than expected. We also want to increase our market share, increase our production capacity, and also adjust our financing activities. Thank you very much.